Today, we look forward to hearing what's on the minds of our incredible set of panelists. So I'm going to introduce each of them to you, starting with Austan. Our first panelist, Austan Goolsbee, who is the Robert Gwynn Professor of Economics at Chicago Booth. Austan, of course, served in Washington as chairman of the Council of Economic Advisors and a member of the President's Cabinet. Before Washington, his research earned him recognition as a Fulbright Scholar and a Sloan Fellow, and he has been named one of the 100 global leaders of tomorrow by the World Economic Forum. Austan serves on the Economic Advisory Panel to the Federal Reserve Bank of New York and has also served previously on the panel of economic advisors to the Congressional Budget Office, the U.S. Census Advisory Commission, and as a consultant for Internet policy to the Antitrust Division of the Department of Justice. And of course, in 2009, he was voted DC's funniest celebrity. So please welcome Austan for returning to EO this year. So I'm going to go to the left here, Randy Kroszner, who's the Norm Bobbins Professor of Economics and Deputy Dean for Executive Programs at Booth. Randy served as a governor of the Federal Reserve System from March 2006 till January 2009, where he chaired the Committee on Supervision and Regulation of Banking Institutions and the Committee on Consumer and Community Affairs. He currently chairs the Federal Research Advisory Committee to the U.S. Treasury's Office of Financial Research. So Randy took a leading role in developing responses to the financial crisis and new initiatives to improve consumer protection and disclosure, including rules related to home mortgages and credit cards. Randy also served in the White House as a member of the President's Council of Economic Advisors from 2001 to 2003. So Randy is a frequent commentator to the international media and provides advice to financial institutions, government organizations, and central banks around the world. Please welcome Randy Kroszner. Thank him for being here. And our third panelist is Raghuram Rajan, who's the Catherine Dusak Miller Distinguished Service Professor at Chicago Booth. Raghu served as the 23rd Governor of the Reserve Bank of India from September 2013 to September 2016. And between 2003 and 2006, he was Chief Economist and Director of Research at the IMF. So Raghu's research interests are in banking, corporate finance, and economic development, and in particular, the role that finance plays in those. Raghu's latest book, The Third Pillar, How Markets and the State Leave Communities Behind, came out in 2019 and was a finalist for the Financial Times Best Business Book of the Year award. Please thank Raghu for being with us today. And finally, we're very pleased to have as our moderator Kathleen Hays, Global Economics and Policy Editor for Bloomberg Television and Radio. Kathleen has covered the US economy and the Federal Reserve for the past 30 years now. And for the past few years, she has broadened her coverage to include the economies of Central Asia and has been doing a lot of work there and traveling to Japan quite frequently, hopefully not on private jets. Sorry, little Nissan joke there. So I want to thank Kathleen for moderating the panel today, and please take it away, Kathleen. Thank you.
Thank you, and thank you for inviting me back. This, as I learned last year, this is not only an informative event with value-added insights, it's also really fun. And I've always been a big fan of saying, you can have fun with serious stuff. So it's great to be back with the dream team, as they were just referred to. And I just say, when I listen to him talking about all these new programs, I think, this makes me want to go back to school, doesn't it? It'd be so much fun. So maybe this is the next best thing. And this year, and it's only my second year, don't make it sound like, we've been doing this for 20 years and here's what we're doing now. We're going to start with a look at tech. And there's so many aspects of this we could talk about, but we're going to really focus a lot on big tech, where we're going, especially what it means for the financial system, and then we're going to move a bit more broadly into our economic outlook. But one of the reasons I want to talk about this is more and more over time, the developments in tech, in big tech, small tech, whatever it is, US, China, doesn't matter where you go, is having more and more of a potential impact or actual impact on where the economy is going. So Randy, I want to start with you. The non-bank system, big tech moving more and more into the banking system. Now, in some ways, I think, particularly starting in the financial crisis, it was pretty clear that a lot of these big banks are ripe for disruption. So where are we now? Is this a risk, or is this something that's inevitably going to happen and maybe even make the financial system more efficient?
Well, there are a lot of challenges and potential risks, but what's kind of amusing is that many of my friends in the banking community say, well, thank God for your former colleagues. It's bank regulation that keeps those big tech firms out, because nobody wants to be regulated as a commercial bank. And so it's much more difficult for entry to come in here than it is, for example, in China, where you have some of the tech firms becoming some of the largest financial institutions there. Because in some sense, it's very natural. If you're on your mobile phone and you're thinking of buying some product from Alibaba, Tencent, someone else, and they know everything about you, and so they know what your appropriate interest rate would be, and so they can just offer it to you right there. If you want to buy a refrigerator, you can click one button to pay full price now, or you can just click another button and pay over the next few years. That's a totally natural combination of things that in the US and actually much of Western Europe, there's a lot of regulation that makes that very difficult. Now, part of the motivation for that is a concern about, now we talk about big tech, but of course there had been a lot of discussion of the big banks and big finance sort of taking things over. I mean, we have a long history in the United States going back to the Jacksonians and the populists sort of rising up against the banking and financial system, in particular, killing what was the prototype for what's called the Second Bank of the United States, which is the prototype for the Fed. And so it's interesting that we now see tech kind of taking on that sort of big tech role. People are very concerned about it. But in some sense, there's an unintended piece here that banking regulation is keeping some of them out, some of the tech players out. But certainly, we see that in other areas that don't have that, a lot of entry.
Okay, well, we're getting Raghu's mic straightened out. So meanwhile, we're going to let Austan jump in on this. What do you think when you step back and look at the economy and the interaction between banks and credit and all this? Do you see this as a big trend when you're looking at
I mean,
tech
it's
coming
for sure, it's a huge trend, not just in finance and many things. I think the lesson of China and the financial payment system is kind of a sobering lesson. I think there's a major component of people who feel good that either because of antitrust or because of financial regulation, we've kept that consolidation of the biggest retailer, the biggest payment system, and the private space all being one and the same. I think it's natural that they will find inefficiencies in the current financial system and improve them, and that part is good. I think the FinTech universe is maybe less concerned about financial stability as traditional financial institutions, so that makes it a little more worrisome, I think. And I think in many of these, if not a natural monopoly, they're big economies of scale. So it probably will be that once the system rolls out, it will look like the Chinese system or others in that there'll be a small number of very big players. And then FinTech will be in exactly the same hot water and messy space that all the other big tech firms are, where we're looking, we can't help but say, well, look at how much power they have, and should they be broken up, and how can they be controlled? And I think we'll have a bunch of important decisions to be made. It's just they're probably a couple of years away.
But I think that's one of the big concerns, right? I mean, because we know, so Raghu, you jump on this, you can all jump in on it, that the government, understandably, the Congress has a hard time not bailing out any kind of financial firm. I don't care if they're non-bank, fintech, whatever. That seems to me to the concern that if you're saying, yeah, they might take on more risk and they kind of evade the rules, then are we just setting ourselves up for some kind of excess, and China's had plenty of those, that we're going to have to pay for?
Yeah, I mean, that's a very big worry. I think this is a new beast, right? It brings together data. It brings together networks. And of course, that together with all the other stuff that they're doing creates an enormous amount of power. That's what Austan was talking about. We can get to that. But on the fintech side, I think the big concern is many aspects of fintech are trying to bring value to a place where there are economic rents. And one of the concerns is when the rents dissipate, are they still going to be able to make money? Or are they going to engage in this ruthless competition which drives sort of profits down, in which case you may get the excesses that you're talking about? Let me give an example. There are hundreds of people trying to get into remittances, because remittances is where you see Western Union charging an arm and a leg for transferring money across border. Well, we'll get in there, we'll charge half the price, and we'll still be plenty rich. The problem is once you get in there, Western Union is going to cut its prices, and you're going to compete with 5 other people doing exactly the same thing. So they're not thinking beyond that first step when they disrupt the industry, and then they have to compete for new business. And this is where I think I want to believe the marriage of big banks with fintech would be better than fintech alone or big banks alone. The problem, of course, is there are cultures which don't necessarily mesh, and so they don't necessarily come up with the right products when you get fintech into banks. But the banks that can figure out, here are some real problems we haven't succeeded in dealing with. When we bring fintech to this problem, we can reduce transaction costs tremendously. We can make it much easier for the customer. Therefore, there's big value here. Those are the guys who are really going to benefit from the banking side on doing this. And of course, there will be fintechs who will figure it out on the other side.
Though, the thing is, like with the accelerated attention paid to artificial intelligence, there are examples where AI and fintech are improving things a lot. But thus far, it's still much more promise than it has been reality. And if you go look at Bitcoin, for example, it's not even reducing the transaction fees. The transaction fees are actually still enormously large, and in my favorite example, they had the big Bitcoin convention, and they refused to accept Bitcoin as payment for the convention because they said the fees are too high. They would charge 25%. So I still think we're a few years away. It could be a big thing, but I still think we're a few years away.
Yeah, and I think exactly as Raghu was saying, so far the major financial institutions have not been able to take advantage of their natural advantages. So, the large banks know an enormous amount about you. If you have your mortgage with them, you have your credit card with them, you have your bank account with them. So in some sense, that's the data that all the fintechs would love to have. But the banks get this naturally in doing these other functions. They haven't been able to marshal that, to be able to say, and here's the right product, or here's the thing that we should be offering to a particular customer. And it's, because I've talked to a lot of the banks and boards about this, because they want to get there, but their cultures just don't mesh. So what they do is they hire all these people with like plaid shirts and woolly caps and long beards, and they get on the elevator with Jamie Dimon, and they can't stand being on the elevator with Jamie Dimon as he's there in his suit and sort of dressed kind of like we are. And so they go into the office, they do that for a year or two, then they leave, and they do their own startup and then sell it to Jamie Dimon. But the big banks haven't been able to take advantage of that yet. It's really quite amazing that their IT systems are so poorly structured that they can't do this. And actually part of this is sort of the long legs of banking and financial regulation. Because as I think I've mentioned to this group before, we used to have these completely crazy laws that made it very difficult for banks to branch. And so especially in the old days when you didn't have markets where you could diversify, the only way you could try to diversify is geographically. So it's like someone read a book on finance and said, okay, how can we make the banks as risky as possible, make them put all their eggs in one basket? Well, we eventually got rid of these laws, and so all of our major financial institutions have come, as in some senses, like Frankenstein monsters of these mergers, which I shouldn't call them Frankenstein monsters. It makes sense to put them all together. But one of the things that I think the regulators didn't think about, and this was long before I was at the Fed, was we should have required that they integrate their IT systems and say, that's great, you're making a more efficient structure. It didn't make sense to have 20,000 banks in the United States. We still have about 5,000 or 6,000 banks in the United States, which is a lot. What they should have done is said, that's great, merge, but we won't let you do the next major merger until you've integrated your IT systems. And we haven't done that, and so they're still struggling, and I also think that sets up for a lot of potential cyber risks at these organizations.
Well, this is another aspect of legal risk, right? Especially with AI. We heard Dean Rajan talk about Senthil's work, which indicated bias in some of the AI systems. Well, one of the worries for big banks is that when you actually run some of these systems, there is bias that you didn't figure out. There's some proxy for race or there's some proxy for gender, which doesn't show up, but once you use it, you tend to bias your lending. And then you get the lawsuits, and then you have so much liability, which these fintechs don't have to worry about so much. That's one. Second concern I have about fintech is we haven't been through a down cycle yet.
Yep.
And have we optimized for just the upcycle and not optimized for the down cycle? And what happens then? Can they actually collect the money when people's incomes no longer are sufficient to make payments? So that's another thing we should be worried about. Regulators worry, fintech less so.
Okay.
I mean, the thing in the financial sector is fundamentally about trust in your financial institutions. That's the strength of any bank is its reputation. And the payment systems now, it's gone bonkers. If you got a teenage kid, they will tell you, oh, we want you on Venmo. You know, so I started looking at Venmo. Every payment you make is public knowledge. It's a social network, and there is among young people a level of trust in these startup companies, or maybe they haven't thought about the issues of distrust. Should they be distrustful? If there is a downturn, I wonder if a whole generation of people are going to discover, wait, what? What happened to my money? What do you mean?
Yeah, but everybody's too trustful in tech. Look at the big, they run together in my head. Just in the last week, there was a huge hack in the cloud. Big companies have been just, everything taken over. I don't know. Clouds are huge. People keep going there. And I wonder someday, I'm going to be extreme here, we're going to go back to everybody having servers and not having their stuff up there because it's just not as safe as it looks, But I want to quickly say to the audience, and you're such a lovely audience. When I walked in, I felt like I was going to a football game or something. So exciting, so buzzy. You're sending out questions. I'm writing them down because I want to get through a few things. As the moderator, I can selfishly make sure I get to ask questions I want to hear answered. But we're going to start bringing in your questions and plenty of time to run through a lot of them. And another thing I want to ask you guys about, in the academic world, I love things like this where you have someone like Mark Carney. He's suave, he's smart, he's been the head of the Bank of England, he's leaving, giving this kind of surprising speech about, was it 3 months ago, where he talked about digital currencies, how they need to be developed, forget the dollar, this is going to be, more secure, more something. And then I love it, just a few days ago, Gita Gopinath, she's now working for Christine Lagarde, right? Very, very prominently.
She's a former Booth faculty member.
Started her career at Booth.
That's right. Yes. In an op-ed in the Financial Times, oh, come on, central banks develop digital currencies. Are you kidding? Dollars, all kinds of reasons why it's the world's reserve currency. So I want you to start on this, Raghu. Where do you stand on this question?
So I think she was reacting to the notion that somehow others will develop a digital currency which will take over the role of the dollar. And I think that may have been the thrust of Mark's speech, though I've only read reports of it. And I think she was coming at it from the perspective of her research, which is the dollar is really dominant. There's a lot of pricing of exports in the dollar. One of the reasons people trust the dollar, and 60% of pretty much every transaction in finance is in dollars, is because it is a deep open market, and the US historically, till very recently, didn't try to use finance as a means of pressurizing countries. One of the concerns is that this politicization of the dollar now may in fact cause people to turn away. One example is Russia, which has moved away from holding its reserves in dollars, at least to the extent that it did, and you can imagine that could could expand if the dollar is used as a weapon. But her broader point was more about the view that the dollar would be replaced. And I don't think we need to go there to argue that digital currencies could have a strong future. The question is, will it be central banks that will issue them, or will it be a Libra or something like that? Again, it's the power of networks, it's the power of information. One of the big concerns that central banks have about Libra is, first, this is not a company that is well known for protecting your information. It's also a huge monopoly in its own right. So add to it a payments monopoly, and what else can that lead to? That's certainly a concern across the world. And certainly from the perspective of small countries, a very big fear is Libra will displace their own currencies. Because it's so much easier to use, and if you can get in and out easily, why would you hold a depreciating currency in a small developing country rather than move into the Libra? So these are concerns that need to be addressed. I think one of the big concerns Libra has always had is they have to persuade the regulators, and I have to say right now the regulators have not yet been persuaded.
And look, just think about every country of the world. I kind of don't understand what the circumstance Facebook would want to get into this, in that any illegal activity, if you go look at Bitcoin, a vast chunk of the transactions are obviously, they're not good. We had a woman came and gave a paper that analyzed the whole blockchain as of, I think her data went up to 2017 or something. And she said, well, 25% of these transactions are money laundering. And in the audience, we were like, well, how do you know that? And she said, well, they're people coming from the sites moneylaundering.com, launderyourbitcoin.com. I was like, what? So imagine now Libra becomes the big currency, and somebody makes a payment. Somebody buys whatever. I send you a payment for a terrorist action, or I buy drugs, or whatever. Every country of the world is going to view that as a massive threat to their sovereignty, and they're not wrong, and they're going to try to hold Facebook accountable in their country for facilitating criminal transactions. And they're not wrong to do that. You know, they're going to say Facebook should go put some regulator and govern what's happening in the transactions the way banks do, and then once that happens, they're in the regulated world.
Austin, just on that point, I mean, it is true that Bitcoin would be used largely for laundering. Otherwise, the transaction costs are not worth it, right? If you want to make a payment to your for your coffee, you're not going to use Bitcoin precisely because of the cost that you pointed out. But it is possible that something like Libra could be so easy to use that the vast majority of the transactions are legal and some small minority are illegal, as true of money also. True. But you're absolutely right that they have a huge amount of reputational risk, and they will have to convince central bankers, one, that they will be able to control the know your customer problem,
right?
But also, I guess, that they will not misuse the information and the networks that they obtain as a result.
But you know they will misuse it. I mean, that is the...
But this is the interesting thing. They really know their customer. Unlike others. There's nobody else who knows their customer like some of these big tech firms. No, it's very interesting to see this sort of back and forth about whether central banks should be issuing a currency or not digitally. And there's been a lot of discussion about whether China is going to do that, because the Chinese central bank, and so the Chinese system, works rather centrally, and so if they want to eliminate currency, and if people object, the objectors are not going to get very far. They will be able to execute on that. And it's going to be very interesting to see if they do something like this, because that, again, could be a very interesting test case for how things would operate. Because obviously it would be all centrally controlled. Mm-hmm. Every single transaction would be monitored. Many of the transactions are already monitored through the large FinTech firms, but this would make it complete. And in some sense, it's very interesting to see the different models around the world. So you have GDPR in Europe, which is a lot of data protection, privacy issues. So a lot of fragmentation of data. China's the opposite, where everything kind of goes into the central government's computer and they can monitor everything. And we're sort of somewhere in between. And it's going to be very interesting to see how that develops. Is that something that's going to be a strength for China, that's going to be difficult for the West to compete with? Or is it something that is going to lead to more problems because people become outraged in China of the extent of this monitoring and sort of rise up against it? I think that's one of the big political economy questions that come out of these big tech issues.
Okay, I want to just put a very broad question on the table in terms of technology, innovations, and for each one of you, like, what's sort of the biggest plus and the minus? Because it's great to see many things disrupted. They do get more efficient, new things happen. And at the same time, some people worried about some concentration developing in the economy. Competition, innovation, equality. What's for each one of you, like, what's the big question right now?
For me, it's what do we do about the jobs that are lost due to automation? That's going to continue. That's possibly going to increase. How do we find ways in which people can rediscover good work? And I think the first thing is, obviously, as people lose jobs and wages sort of fall, the market will react to some extent. But the question is, can we prepare them better for the kinds of jobs that are emerging so that some combination of tech and human will emerge again to do a better job than tech alone or human alone? And I don't think we're thinking very hard about it. We sort of throw out education as something that's necessary, but what kind of education? And how do you get education to the places that are being left behind? What do we do in those places? What should those places do, and how do we facilitate their doing it? We haven't had that conversation, and I think this is the central conversation that we should be having, because this is the source of political fracture in a number of industrial countries. And if the reaction to that political fracture is to actually put enormous constraints on markets, on corporations, etc., we will eliminate our ability to actually react to the problem.
What's interesting is that I think it's more the fear of that than the actuality of that. Because if you look over we just got the jobs report this morning, and it's astonishing that we've had basically more than 20 million jobs created over the last decade, the unemployment rate at 3.5%. And what's interesting is that there's been more job growth at the low-skilled sector. The reduction in unemployment rate has been greater there. The growth of jobs has been greater there. So we actually haven't seen this yet. But I think it's an issue because people fear that. But it actually hasn't happened yet.
Well, what has happened is the jobs that paid at the middle level have disappeared, and you're getting many more jobs at the lower level and some jobs at the upper level. But there's a gap in between. Now, whether those were protected by strong unions and there were rents there, or they were truly sort of well-paid jobs, the reality is the middle is much thinner than it used to be, and this is across industrial countries. So today, to get one of those really good jobs, the leap you have to make in terms of your skilling, your education, is much higher than it used to be in the past, where with a high school job, you get a good job at GM, and you're made for life. So I think you're absolutely right. We're talking about jobs in a period where unemployment is really, really low. And so we need to ask, what jobs are we talking about? Well, not the kinds of jobs which put a earpiece in your ear and tell you which bin to go to next to pick up the stuff that you put together in a packet and send for Amazon.
And not to add a potentially depressing component to that, if the economy's doing well and the unemployment rate is this low, and people are already so angry about wages and immigration and blah, 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 imagine what happens during the next recession. I mean, it seems like this could be a dark path, in a way that
I see this in the UK, because the UK has near record low unemployment, a very high labor force participation, and part of the Brexit support is exactly on these sort of labor issues, where it's sort of hard to see where, it's very hard to make an argument that people are losing out on their jobs because of competition from immigrants, because the unemployment rate is so low and labor force participation is high. And so I think That's one of the big things that will come with the next downturn, not just what will happen with the risk models in FinTech, but exactly as Austan said, if people are upset already when the unemployment rate is at record low in so many countries, what's going to happen when the unemployment rate goes up?
So let's look at what's going to happen this year, because one of the things that's interesting about the jobs report this morning, the payrolls growth did slow down a bit. It was only 145,000 new jobs, down from 266,000. That could be kind of volatile. But I think one of the most interesting numbers was average hourly earnings, basically a measure of wages, because it was only up 2.9% year over year. And it's never gotten that high since the last, since the Great Recession. It was up to maybe like 3.5% year over year 1 month, but it used to be a lot faster. And that's with not only the U3 unemployment rate staying at a 50-year low, but the U6, a more newer number that brings in, people working part-time because they can't find another job. It got to an all-time low. And in an environment like this, wages can't rise. Where are we, guys? What's happening in the year ahead? And let's start, I guess, with that aspect of it, the labor market, where it's going, and is it finally going to get tight enough for people to start making some more money because they're getting more jobs and put us on another course or a faster course? Go ahead, Austan.
Make a joke.
Look, I think if you're of the view that you think the job market is about to get really hot and wages are going to start going upward, you're in the camp of the inflation hawks, and the problem there is they've cried wolf for 9, 10 straight years. Say, in 2010, they said we're about to unleash the wage price inflation spiral. And in 11 to be 12, 13, 14, et cetera. And now they're saying, look, now it's 3.5%, it's about to go up. And that might be true, but I guess I find it implausible just because it's been wrong so many times before. I think in the jobs numbers today is just a microcosm of this weird thing, which is we basically have two economies. Anything that deals with the consumer and the job market looks excellent. And anything that's on business investment or manufacturing's actually been in decline for several months.
Manufacturing jobs were down 12,000.
Manufacturing jobs were down a bunch, and that's why I say that's kind of in microcosm. And overall GDP growth has been mediocre and slowed. So it's what we can't figure out is which of these is right. Is one of those is a leading indicator of the other one, but we just don't know which. Am I in front of the line? No, you're in front. We're in a circle. We don't.
So what's difficult to understand is you get into a room with business people and you ask them, how's it hiring? They say, impossible. I can't find the right people. I'm willing to pay. I'm paying a lot, and I still can't find people. This is a very tight labor market. So that would say the old forces that we thought about, higher wages, should show up sometime. We should see greater inflation. But there are many steps here which have to play out. One, your hiring at the entry level may not translate into an across-the-board wage hike, especially if a lot of older people at higher salaries are retiring and your average wages don't move up that much. That used to be the Japanese phenomenon, and with the retirement of the baby boomers, it's possibly something that's happening in the US also. So looking at the details of the labor force in your firm is actually very, very important. The other thing that seems to be happening is the usual, a lot more automation when you find people hard to find, a lot more up-training within the company of entry-level people to do higher jobs when you find you can't find those people. So companies are reacting. So as yet, it doesn't seem to show up in generalized inflation of the kind we saw in the past. And some of that is possibly also because expectations are reasonably anchored. People aren't saying it's going to be 10% higher next year and not demanding that kind of wage increase. However, so I think the hawks are wrong. It's not going to happen tomorrow that we suddenly have an outburst of inflation. But at the same time, the doves are also wrong in the sense that this is never going to happen. I think what we'll see is a steady increase in the cyclical component of inflation, even though some of the longer-term trends, especially stemming from population, go the other way. So we will see a steady rise in inflation if monetary policy stays on hold. But this is where the Fed has been thumping on the table and saying, we don't care if it goes up a little higher. We're willing to watch it. We're not going to be preemptive. So interest rate increases for the foreseeable future until we see inflation really pick up are off the table.
Well, and so Randy, put yourself back at, 20th and Constitution, and you're sitting at the table with the other FOMC members. Where would you be right now? I think a lot of them, look at do you guys follow the dots? The Fed every 3 months updates its view of the GDP and employment and inflation. And the last dots were there were 13 out of 17 who see no rate changes this year. Only three that do, maybe one. Where would Randy Kroszner be right now? Where do you see the economy going, particularly when you look at what we saw in the jobs report from December?
Yeah, I feel like saying, I am not a dot. But I'm not a crook, I am not a dot. So actually, I wanted to get build on one of the things that Raghu said, because I think the data on the wage growth, we have to adjust it because what he was saying is one part of it, that you have a lot of retirements of relatively high wage people. And also the other piece of it is what I was saying, that you've had this disproportionate growth in the lower skilled sector. So when you look at the average, that's going to understate where wage growth is. So it actually is a bit higher. The San Francisco Fed has been doing some adjustments of this. It's not dramatically higher, but it's not quite as low as it seems. And the Fed certainly looks at those kinds of things. They're thinking about what are the, where are the wage trends, where is the pressure. I think the thing that's very much weighing on the dots and keeping them low is the specter of Japan. Because Japan got into a very difficult situation and is still in that difficult situation where they acted a little bit too quickly when inflation started to come up, because they were in a deflation situation. It came up basically to zero, and then they started raising rates because they said, we're worried that the tight markets, tight labor markets, and our growth is going to lead to high inflation. Well, that led to a situation that people no longer believed that the central bank was really very credible and very committed to fighting inflation. And despite incredible amounts of asset purchases, they now have a central bank balance sheet more than 100% of GDP. Despite Abe, when he was elected, making this super salient publicly, saying this is one of the three arrows of Abenomics, which is to fight deflation. Despite putting in someone whose whole reputation was that the central bank could do more and had no limit in being able to fight deflation, they still haven't been getting anywhere near 2%. And so I think the Fed is very worried about trying to get ahead of things, and is worried that since they can barely get to 2% even in this situation, they're going to hold back. And I think that's, from their risk management point of view, that weighs on them very heavily. And I think that's a perfectly reasonable thing that's going to leave them waiting for the inflation to come. Also, they're doing a bigger rethink of their fundamental model. And so they've had this for the last, since 2012, a 2% inflation target. Well, they've been under it for every year for the last 7 years since they've had it. And so probably the new regime will say, well, if we've been under it for 7 years, we'll kind of be comfortable for being over it for 7 years, or get the average to 2%. And so that, again, is trying to get people to expect, the Fed is not going to stop when they get to 2. And so that you don't get into a Japan-like situation.
Even Eric Rosenkranz, Boston Fed, who's pretty hawkish, is, I think, signaled the willingness to see the inflation rate in a range, et cetera. So I want to bring in a very simple, smart audience question, because we're looking about where we're going. And the longer the expansion gets, the more people think, gee, are we going to have a recession? Now, I look out, and I don't really see any big recession risk right now. But Austan, I know you're worried about manufacturing. When we're talking about the Fed, are you sitting there thinking, yeah, whatever, we need more, but you're worried about manufacturing being weak. You're worried about all those other things. Is that somehow where a recession is going to come from? Or are we going to get like Australia? They haven't had 2 quarters of negative growth in 30 years.
I think that these comments are all spot on, and I would just, the Fed, it was barely a year ago. You remember our discussion last year was coming out, the previous December, the Fed was saying they were confident they were going to raise rates 4 times in 2019, and some people were saying, they're being conservative, they're going to raise it 6 times in 2019. And instead we end up cutting rates because this same dynamic that it's really hard to get out. You have a financial crisis. It's a struggle. You got to change. You have asset bubbles pop. You got to change the focus of what they're doing. My advice to you is don't get over optimistic. It again sounds like people are like, well, we made it through that risk of recession. Now it's not there. I still think if you look at the 15 recessions, or 14, depending on how you want to count them, post-World War II in the United States, Fed interest rate raising or keeping high is by far the biggest cause of recession. It's about 2/3 of the recessions. Popping asset bubbles is the number 2 cause, and rising oil prices is the 3rd. Now, rising oil prices is not as big of a risk, but of the 2 major causes, you at least got to say there's a yellow light there, and that the last 5 years of policy decision and stated understanding of the economy hasn't been that great for the Fed's model. It's good that they're reevaluating the model, because the model's been wrong 37 quarters in a row in the same direction, the same way.
Some people have been arguing lately here and there that it's wrong to always say, we've got to keep the expansion going. We're going to avoid recession. At some point, recessions are healthy because they clean out excesses. They clean out things that have developed that shouldn't be there. Oh, look at Austin. You don't agree, but does
I would just say, I'll take the jury trial on that one. Your advertisement is like, let's embrace a recession. It's going to be good for us.
Right. I think the better way of saying that is not so much to create a recession, but to be wary that as the expansion proceeds, the risks build up. Now, the 2 traditional risks were inflation. As the labor market gets tight, inflation pops up. We've just talked about it, say, not that big a risk, and it's probably going to be more gentle than in the past. The second big risk is not so much asset bubbles as credit, because that's the greater danger we've seen. Credit is getting a little iffy. Periods of extended liquidity, especially combined with a stronger sense that the Fed is there to back you up if things go south, which has been reinforced this year after the Fed's about turn in December, means people are willing to take more risks. And where are the risks? You see it in private equity, you see it in a variety of other places that credit has expanded. A lot of people sitting in BAA instruments. What if it gets downgraded because of a downturn in the economy? There'll be a lot of crowded trades around there. Lots of pension funds and insurance companies have gone out on the risk spectrum because they're searching for yield. Now, a lot of this is predicated on interest rates remaining low. So to the extent the Fed stays put, not as much of a worry. To the extent that the Fed is forced in some way to raise interest rates, perhaps more of a worry. Worry for term spreads, for credit spreads, all those could expand. They've tightened a lot, and higher interest rates would create that asset bubble collapse. So the reason I think at least some of us in this panel are a little more sanguine is we don't really see that pop up in interest rates anytime soon.
Okay.
It's not a reason not to be worried that the sort of fragilities are building up.
Okay, I want to just throw out a couple more things on the table, and I'm going to continue to start working in more of our lovely audience questions. We've had from, gosh, what's today? It's Friday. Just over a week ago, we've had all of a sudden a huge increase in geopolitical risk. And one of these that brought it back to mind was, Raghu just mentioning, oil prices aren't going to go too high. And we have interviewed tons of people in the last week, strategists, economists, what the risk is. As long as oil, and actually there's tons of supply, so supposedly very hard for oil to move above $70 a barrel right now. Does this change affect the economic outlook for this year at all?
I don't think it does. Let me just say the reason I said that about oil prices is the danger. 3 things happen. 1, we became a huge oil producer, so if the price of oil goes up, there will at least be some significant part of the U.S. economy and manufacturing economy that benefits, not goes down. Prices haven't moved that much, and the U.S. economy's gotten a lot more energy efficient per dollar of GDP than they were in the 70s and 80s. So it could be tumultuous in oil markets if things go a certain way. but I just don't think that that has the same economic impact that it used to.
Well, I'll differ from you a little bit here because I think sentiment matters. And one of the things the Iranians showed us earlier last year was they could essentially target all of Saudi Arabia's oil facilities. What happened that time is it didn't make a big difference to the oil market because there's a lot of spare capacity which came back on at that time. But the repairs are still going on because they were pinpoint in how they targeted the Saudi Arabian facilities. I can't believe that the Iranian reaction to what happened to their general has ended. I have to believe there is another shoe or whatever waiting to drop, and there will be more back and forth. I hope that it is mild, it doesn't provoke a reaction from the United States. The United States doesn't feel it needs to react. But I think geopolitical risk is certainly on the calendar, and I'm not sure there's that much spare capacity in the oil markets if the Saudi facilities or the UAE facilities are targeted in a very careful way. That's one. The other thing I think we should pay attention to is trade risks. That we're again banking a lot on the China and the US coming together with this interim deal. My worry is, first, it's taking a long time to iron it out because it's very complex to get even to first base. But there's a lot more to be done here. And how does this play out? How does the trade frictions with Europe play out? We have a president who is not very predictable. And my worry is that this could be a source of risk as we go on into the next year, into this year.
But trade has actually had very little impact, very little negative impact on the U.S. It's a small part of GDP. Even with these very high-sounding tariffs on China, it's just trivial for the overall economy. It's very painful in the particular areas that it's hitting. So I don't want to suggest otherwise. But overall, it's had very little impact. The CBO has estimated very small impact on GDP of all these trade issues. So I think it has a much bigger impact on China. I think that's why the president sort of picks that, because it's something that he feels he can put more pain on an opponent than on ourselves. So I very much agree that I don't think this is over. It's not even clear that the deal is going to be signed on the 15th, because we now hear the president said, well, maybe it's 15th or soon after.
Trivial.
It's on a few soybeans and a few cars that really isn't going to matter all that. It's not a hill of soybeans. It's not going to matter all that much. I mean, whether we have it or not, it's not going to matter very much for U.S. GDP, but the issue is going to continue to be there. And I think the issue gets back to something that Raghu had said about sentiment.
Yes.
And I think all of these things are, whether it's geopolitical risk, the oil markets and other things, it's about sentiment, because there's something that we don't fully understand about why investment has been so low. Because you've had this astonishing recovery. You've had over a very long period of time in a large number of countries. You've had unemployment rates at very low levels. You've had promises from central banks to keep interest rates low for an extended period of time, and they have. And many central banks have made them negative. Well, that makes a lot of investment projects look pretty good when you got negative interest rates, but no one's taking the bait. The concern had always been, well, we go negative, and so all these crazy investment projects come up, because who can't beat a negative hurdle rate? Well, people aren't doing that. And that's something that I don't fully understand, and I don't know if you guys have a good explanation for that. But that's the thing that worries me about the length of the recovery, because as you know, last year, even though the stock market was down, I was relatively optimistic because I didn't see in the fundamentals of the data that things going south, and I think we had a reasonably good year. But my concern is that to sustain the recovery, at some point you're going to need investment. And if you have some of these risks that are there, whether they're perceptions about trade, even if it's not the actuality of trade, whether it's perceptions about what's going on in the Middle East, if we have even less investment, I think it then becomes harder to maintain growth.
What do you hear in China? I mean, you've been going to China a lot, and but I think that's the kind of the other side of it. If this is a trivial phase one deal, I get it. You're in China saying, yeah, we showed him. We knew Trump would step back. I'm not convinced he's really stepped back. I don't know with so much going on if he's really going to push hard for phase 2. And of course, many people say, oh, forget it. They won't stop subsidizing their small and medium-sized businesses. They can't and they won't. And when it comes to intellectual property, they're never really going to do anything there. At some point, does everybody just move on? And do we need it? Should we care? I mean, one of our audience questions is asking about how much of the weakness in manufacturing has been caused by the tariffs, right? Could there be other things that are causing manufacturing weakness, like not enough skilled manufacturing workers? But I think that's a decent question. Like, are we paying a price from this? You seem to think not so much. Is there a risk if we do let it go? Is there a risk if the president keeps pushing?
Well, more than trade, I think, is the issue of investment and global supply chains. What this conflict has done is thrown a lot of uncertainty. If I produce in China, will I be able to supply my factories in the US? Because something may come in the way. Will I be forced to excise a Chinese company from my supply chain because either we increase tariffs or because we ban that company from supplying? So there's a lot of uncertainty about this, and the natural reaction over time is, let me separate myself from China. Let me make sure that my supply chain goes through friendlier countries that are not going to be influenced by this. And that same logic is playing out in China. Am I going to have enormous exposure to the US market? Am I going to buy a lot of chips from US companies when I know that ban can emerge? So they are, in a sense, trying to innovate to find their way out of this. Expect in the next 5 years they will be far less dependent on some of the key US products that they buy today. China, by the way, has made enormous strides in innovation. So at some point, and this has been a fact of history, when countries innovate themselves, they strengthen property rights because they want to protect their intellectual property, get innovation. China's getting to that point. So I wouldn't be too pessimistic about China protecting intellectual property, but what I would say is they're much stronger competitors now in some areas, not all, but in some areas, than they used to be. And that's the reason they're protecting property, not because they don't want to steal anymore.
Well, I think that's a good point, actually. And they did even set up a couple of intellectual property courts, was it last year? And I don't know how much they're using.
They've made
them.
enormous improvements there, enormous improvements.
Well, let's ask a bit about something that's on one of our minds out here in the audience, and something that you sort of touched on, Raghu, and that is more about turning more towards Europe and how that comes out globally. I mean, they're going to have the Brexit, something's going to happen now. Boris Johnson's
You think so?
Something's going to go through. Poor Theresa May, nobody supported her. That's a whole other story. And so Boris has stepped in and going to build on all the progress she made. But, and there's this question of trade with the US and Europe. And there's this question of, Germany still being pretty weak, and it's in large part because China slowed down, because China, isn't Germany the most export-dependent country in the world, even more than the China, exactly. So when we look at the outlook for this year, it's a big story. It's very important, but does it really affect the U.S. economic outlook for the next year or so?
Well, certainly there are a lot of challenges in Europe, as you're describing, and it's no accident that the Europeans picked Christine Lagarde to be head of the ECB. She's a person who's been a finance minister. She was actually head of a law office here in Chicago, and the Bears are one of her favorite teams in the world, as I found out, because I wasn't following them very closely when I was in Washington. When I first met her, she said, I was from Chicago, she said, "How are my Bears doing?" I was like, I don't know. I'm in the middle of the financial crisis. I'm not worried about the Bears.
They were 2-14 at that moment.
Yeah. So was the economy, unfortunately. And so she's a finance minister. She's head of the IMF, and as Raghu and others well know, people often joke that IMF stands for "it's mostly fiscal," and so they put someone who's focused on fiscal policy as head of their monetary, the ECB, the monetary institution, and I think the reason for that is precisely because Europe is trying to get more fiscal easing from Germany. And they wanted someone, so Germans didn't of course want this, but the French and Macron has been very skillful in getting the people into the key EU positions that he wants, to be credible, to be able to convince the Germans that they need to use fiscal policy, because they've been running an extraordinarily tight policy. And in her first speech as ECB governor, she talked more about fiscal policy than she did about monetary policy. And the Germans are now actually talking about fiscal expansion, which is just has been seen as complete anathema before. Yes. So you're going to get, I think, more fiscal expansion, and I think that's going to help Europe, at least in the short run, to survive this next year. But they are very dependent on China. That's why, like, U.S. tariff policy on China has much more of an impact on Germany than it does on the U.S.
Interesting. Yeah, well, of course, Germany is not the only one. In Australia, which has been besmet by these awful bushfires, and they're still going, their government, which has a surplus, is, things have been slowing down. The head of the Reserve Bank of Australia, Phil Lowe, would really love not to even think about starting a quantitative easing bond purchase program against negative rates. Even as they've got all this money they could spend, up until now, they've been very, very reluctant to do any fiscal spending at all. Maybe it's going to change more. But the last couple times I've interviewed Josh Frydenberg, and as recently as, what is this, October at the IMF, no. We promised the people a surplus. But it does seem that this is a problem around the world, or maybe it's not a problem if you want a surplus. Resist. But then it seems to me that the tough part is that it puts so much onus on central banks when things slow down. I mean, do you want negative rates? A lot of people think they're a really bad idea. But it puts central banks in a position at some point where that's all they can do. They can buy more bonds. They can shove liquidity in. They can increase people reaching for yield, and they have negative rates. I mean, is that... maybe not in the U.S. Austin's frowning, but I mean, is that kind of
quizzical? No, I don't have a.
Yeah.
I don't have a strong.
Yeah, but you think about it.
So I mean, my concern is that. So we've had three forces, right? I mean, we have this crisis that Randy talked about. We have the cycle, which we've been talking about, and the third is the structural transformation as a result of aging, etc., of our economies. Our economies are changing day by day. There's that transformation. There's also the place-based transformation. Some places doing extremely well, the big cities. Some places doing extremely poorly, the semi-urban areas which lost big employees. So I think we focused a lot on the recovery from the crisis, which was really good. And since then, we've been really focused on the cyclical component. How do we get this back up? But we're not able to distinguish the structural, that in fact we have aging populations, we have development needs in part of the country. How do we fix those? So whenever the talk gets to fiscal, it's always loosely the Keynesian fiscal, let's dig holes and fill them up again, without specifics. What are we going to do with the fiscal? True. And when you get to what are we going to do, it becomes much harder, because these are deep problems which we need to tackle. We should have been tackling them right from the get-go, but if we had to do it now, it requires design. And nobody's talking about design. How do we get money to Janesville, for example? How do we get Janesville to pick itself up because the GM factory has closed there? That's the kind of thing we should be thinking about. We're really, again, just talking about fiscal in a very airy-fairy way, that it'll fix the cycle. But unemployment is not the problem. The nature of employment is the problem. That's a structural problem. It's not a cyclical problem.
I agree, because it's all about whether it's government investment or private investment. We just haven't been seeing the investment. And so thinking about using, if there are countries that have relatively low amounts of debt outstanding and interest rates are astonishingly low, are there ways that you could build infrastructure or reduce some bottlenecks or do something that will help to catalyze private sector investment? And I totally agree with you, that has not been the focus, and that should be the focus. I mean, there's a lot of discussion about, every city wants to open its own incubator. And so, like, everywhere you go, and I've been doing a lot of traveling around Europe and Middle East and Africa to visit a lot of our alums there. They always want to bring me to the incubator, but a lot of that is that's not helpful. If every city is building an incubator, Well, you're just competing with each other for that. That's not actually necessarily helping the growth of innovation. And so I think we're not using the fiscal resources appropriately. I think a carefully thought through plan where you are focusing on bottlenecks, where you're focusing on high returns and doing things that can catalyze private sector investment, that makes sense. But I totally agree, spending money for spending money's sake doesn't make sense.
I'd also, Randy's admonition before about the haunting nature of Japan on the dot plots also haunts this discussion, because that was their thinking. Will engage in massive infrastructure spending, will engage in massive public spending of various forms. And it didn't increase the natural growth rate of the economy. And you can look and you can say, well, maybe they chose the wrong things, but it does haunt us, I think.
Well, I want to throw out an audience question now, because we've got haunting, we've got this, and I'm a journalist. I'm always going to ask those, oh my God, questions. Everything seems to be a challenge. Is there anything you guys are excited about looking into the next year, 3 to 5 years? You know, what's like, yes, that's going to make such a difference. This is going to be great.
The opening of the London campus this fall.
Yeah.
Come visit.
You have to look at the technology that's coming and say, we can do so much more. And so technology has to be the source of optimism, even though there is a lot of pessimism about the way we're using it now. But the possibilities it affords us are so enormous, whether it's in energy, whether it's in FinTech that we talked about. I mean, every area is going to get disrupted. There was a question earlier about which industry do you think is most ripe for disruption? Education. We still teach in the classroom the way we taught 3,000 years ago. You guys come to the classroom, some of you guys, I know some of my students are here, and you listen to us drone on in front of the classroom. That's the way it's been for 3,000 years, but you know, that could get disrupted. And how much better it would be for people around the globe if they could get the best teachers at relatively low cost, and they could learn fast. I mean, we have all these possibilities, so I'm optimistic we'll figure out a way, so long as we don't put roadblocks in the middle.
I mean, in one, you're kind of thinking long term and what are the grand things, but I think in the just nitty gritty of, since the financial crisis, we recovered in the United States better than anybody else. And let's pat ourselves on the back, and suddenly we did a bunch of things right. The unemployment rate is remarkably low, and like I say, anything having to do with the job market and consumer has been both very strong and pretty sustainable. It wasn't fueled in the mid-2000s. Much of that expansion was fueled by falling savings, so the savings rate for the United States literally got to 0%. The savings rate has remained 5% plus in the US since the financial crisis. So this is, on some measures, as good as any time for that, and it's coming out of what was a very difficult and could have been, and has been in other places, very persistent problem that we didn't have. So I think with this, we should view that positively, even in the short run.
We've made a lot of progress on health around the world. I think there's just been incredible improvements there, and I see that a continuing trend on that. Whether it's just sort of like basic things about mosquito nets so that people don't get bitten with mosquitoes that have particular diseases, innovations in all sorts of areas of medicine. And so progress may be a little bit slower in the US than it has been, but if you look globally, a lot of people's lives are much, much better than they had been, and I think that trend is certainly going to continue because there's just been incredible innovation there.
Okay, what about, since you mentioned education, one of the audience questions was about student debt, how that affects where the economy is and where it's going. You know, there are some who are running for office who say, yeah, just forgive all student debt. There are others who say, well, you know, maybe we should at least means test this a little bit. To me, it's just, there's a lot of questions about how people ever took on that much debt. Anyway, what's the I don't even know what question to ask you about it, but what's the answer? What's important here? Is there something that should be done, something that shouldn't be done?
I will make 3 points on student debt. That you didn't have a specific question, so I'll give you three.
Thank you.
Three ways to think about it. The first is, you will hear some people say, you know, there's 1.2 to 1.5 trillion of student debt, and they will say, is that the next subprime housing bubble? I think that's a wrong way to think about student debt, because the thing about the subprime housing and others, fundamentally what happens is you got a lot of debt and then the value of the asset went down, and so there were a bunch of people underwater, and that was the nature of the crisis. Here, the underlying asset, if you want to call it the asset, of human capital has never been more valuable. There is no sense in which the asset went down. There's still a lot of debt, and if you look at where the debt is versus where the defaults are, they aren't exactly the same. Okay, so the biggest student debts are people, the dean is going to get mad at me, they're people who go to professional schools. Okay, so if you look at law schools, business schools, medical schools, they have the largest amount of debt, but they have very high payback rates. That's not where the default is. On the default side, the crisis is not entirely, but is predominantly people who are starting programs and dropping out and not finishing the program. So they get a bunch of debt, but they don't get the degree. And the for-profit education sector is about 5% of the students and 50% of the defaults on student debt. And so I think that space needs a deep re-examination, because what is happening is, at the same time the payoff for community colleges is the highest it's ever been, they're the most starved for resources that they've ever been. All of the states are saying, we don't have any money. Yes, there's huge benefits, but we can't give you the money. So their enrollments are shrinking, and that's pushing more people into more expensive programs in the for-profit sector, which when they drop out, then they have this debt. So I kind of think it's centered there, and that means life is going to be very difficult for people who are in that space, but that's something different than, is that a threat to the financial system, which I don't think it is.
Okay, well, another question that I think sort of broadly along these lines, one of the audience question was an interesting one, saying, does deflation or very low inflation in the United States relate in any way to large debts and deficits, thinking sort of Reinhart Rogoff this time is different? Is there some, maybe there isn't? It's okay if they say no, there's no link, don't worry. But I mean, does that somehow tie into why we don't see prices rising?
I don't see a direct link between the two. Certainly you could find some examples of that, but I don't think there's sort of systematic evidence of that. Now, the challenge is I'm not giving you a good alternative explanation, and I think as Austan and Raghu were also saying that we're not quite sure why we're having such low inflation.
But isn't it partly because we have technology which puts all kinds of prices out there? It makes it much clearer how much goods cost, maybe how much services cost, so maybe how much you're worth. Doesn't it have something to do that it started years ago with China, many, many years ago, when they pegged their currency to the dollar? So they have very low wages. Don't low wages in overseas countries have some impact on wages domestically? Now you'd say, well, Kathleen, that's only in comparable industries like manufacturing. But aren't there a lot of things that are holding prices down and holding wages down?
Maybe, but just remember, most of the U.S. economy, as Randy said before, doesn't face foreign competition.
True, but
we're mostly domestic.
But technology and all the technology has had a huge impact. That's one reason why we've lost a lot of middle-class jobs, because all those middle manager jobs started being outsourced years ago. The more we had technology coming in, so you don't need somebody to do that job.
But Kathleen, that's absolutely right, that the labor market expanded to being a world labor market, and that put pressure on wages for a long time. But with unemployment where it is, I mean, there is sort of wage pressure building, and if in fact the world was so competitive, we should see some of that demonstrated in higher prices, right? Because you're saying people have very little margin. Instead, the talk today is they're absorbing some of these wage increases in their margins.
Yes.
And that would suggest it's less competitive, at least at the firm level. And it's I think I would echo Randy. We don't really understand what's going on very well, and I think we need to understand better role for research.
Okay. Another couple other questions. Oops, one just moved down. I won't be able to ask it. Oh. Do you feel tech giants are subject to a sufficient amount of antitrust regulation today? And I think that goes directly to Elizabeth Warren's push to say, no, you have to break them up. And interestingly, I don't know if you guys know who Roger McNamee is, Elevation Partners, who invested with Bono years ago in Uber and so many companies. Roger has written a whole book called Zucked, and he's totally behind this. So someone who's been in Silicon Valley for a long time, he actually started as a mutual fund manager, feels that this is a big issue. As economists, as professors, what do you guys think?
I don't think there has been enough antitrust scrutiny of purchases of small companies that could be potential competitors. I've been more on the side of a more muscular and aggressive posture toward the big tech companies. That said, I think the knee-jerk, well, let's break them up, is kind of doesn't really make sense. And if you start thinking through situations where there are network externalities, breaking up Microsoft in the old days into two separate operating system companies would just lead very rapidly to one of those becoming a dominant operating system again because of the economics. But I was tempted to give it as the answer when you asked, well, what's some big thing that's pressing right now that we should think about? I think it's worth remembering the last time there was this much disruptive technological change in the Industrial Revolution and the turn of the century, how much it changed politics, and that it was precisely in response to the feeling that the government is not doing anything, that they literally changed the Constitution multiple times. They made senators directly elected, women got the vote. They instituted all of antitrust policy. They changed the Constitution to allow an income tax where it never existed before. If you just keep stuffing that under the rug, eventually the piles of dirt get so big that everyone starts tripping on it. And I wonder if we're approaching that environment. And as some of the questions have been going by here, some have been about Bernie Sanders. It must drive Bernie Sanders bonkers that a billionaire, Tom Steyer, has spent 10 times more on television advertising and 100 times more on campaign expenses. And I don't know if you saw in the latest poll in South Carolina, I think Tom Steyer just passed Bernie Sanders in support. And a world in which billionaires are competing in the same primary with populists who are saying, let's burn it down and break them up, is a strange world. And, that's the one we're in.
Yeah. I mean, I think on tech, we have to be careful. I think the old ways of regulation may not work, but we have to recognize the old concerns in regulation about excess power. For example, the Brandeisian view still is there, which is why Austan says we should probably think about this before it overwhelms us. I mean, there are alternatives to breaking them up. For example, if the big concern is networks and data. On networks, interoperability, everybody says can't be done, but if that could be achieved, that would give smaller guys a much bigger leg up, because now they can access the same network that the big platform has, and they can reach everybody. So that might be another way rather than breaking up. The second is data. There's a lot of data being captured and monopolized. Should that be captured and monopolized? Are there ways of sharing it so that everybody has a level playing field? The reality is these are companies that are giving a very good service to the ordinary consumer, but that can't be our only metric. Our metric has to be what else is going on, who else is paying for this, because there's no such thing as a free lunch. And it could be we're paying today through the high cost of, through the advertisers paying them. It could be we're paying tomorrow because of lower innovation. So the question is, how do we fix these? Maybe a different antitrust than the past.
I mean, the example that Austan gave of the attempt to break up Microsoft because of this dominant operating system, because that's laughable today. I mean, that's what was killing them, because they were trying to stick to just what they were doing in the past. And it's Satya Nadella, who's a Booth graduate, who sort of saw that it's we should do Microsoft should do something completely different. Should effectively compete with what it was doing. Should acknowledge that people are not buying as many laptops and go to the cloud and do other sorts of things. So to have broken up Microsoft and put on that would just be completely irrelevant and crazy today. So I think it shows those kind of structural remedies they may seem very sensible today, but in 5 years from now they may seem kind of crazy. And so I agree. I very much agree that we need to rethink what is it that's at issue, because it used to be one of the key things for antitrust was power over price, but now so much of what occurs is free. The power is precisely because they're not charging.
But it's never free, is it?
Yeah, exactly. The voice of God. So it appears, it appears to be free. Obviously, you're paying with it. There's a reason that they're giving this something to you. But in terms of the traditional price, it's not a price mechanism.
Right.
A traditional price mechanism. It's a data mechanism. It's a services mechanism. It's an information mechanism. It's something that's very different. And because so much of our antitrust law is about traditional markets where power over price was a reasonable metric, we have to think of new metrics when price isn't really the relevant issue. And we're not there yet.
Okay, really quickly, I'm just going to ask you each one final question because I think we've just about run out of time. So when you guys look out over this year, you've kind of mentioned this, but each one of you, when you speak to our audience, what's the number one thing you're watching this year? When you're watching the economy, when you're, what's important that, oh boy, that made the difference to her, for better or for worse, what is it? You can think for a second, like 10 seconds maybe. I know it's a big question.
So I guess the thing that would, if you think, asking what the biggest risk would be, or concern that I have that we're not well prepared for, would be cyber risks. So if you think, there's all of our discussions about big tech and about data, just think if someone were to, and these things are usually not just some bad actor from the outside somehow getting into a system and disrupting things. Usually it's someone who's a disgruntled employee who has the keys and then may work with some bad actor. But let's say you have some disgruntled employee of a large financial institution who helps some bad actors to get in. And let's say just that large financial institution becomes somewhat uncertain about how much is in everybody's account. What happens to the payment system? It completely grinds to a halt. Now maybe the Fed could step in and say, well, we'll make good on all those accounts, but it's possible they can do that, but that's not something they're not ready to do. They don't have the information for, and that could be extraordinarily disruptive. And so I think it fits with this big tech issue, and I think that's something that we're just not well prepared for.
Okay.
So, he's taken cyber, so I have to look elsewhere. I would say geopolitical. I'm very worried that the world has too many strong men, and they're really, most of them men, who have very sharp elbows and seem to have very thin egos. I worry that gets us into a situation where people are unable to back off. We've seen that in the China-US. I'm glad that we've seemed to be finding at least a pause. But there are so many areas around the world of potential conflict. We haven't talked about North Korea. We certainly haven't talked about the various people in the Middle East. Russia is another potential area. So I don't see, we do need to recreate a new world order. We've just thrown the previous one out of the window, but I don't see momentum behind that. And to my mind, this is a process of the next decade before we feel safe again.
For me, I'd say, let's ask, at our meeting next year, what will be the biggest change? And then if we were still meeting here 10 years from now, what's the thing to be watching? For next year, I think what happens in the election in the United States is going to have the biggest impact on policy and on what that's all we're going to be talking about next year is what does this mean. So I would keep an eye on that and don't necessarily believe the information if you're reading it on Facebook because they're allowed to change it however they want. Over the longer term, I think the thing that you should keep your eye on is the productivity growth rate, especially in the United States, but everywhere. Because we, the economists, have always said that is where our standard of living comes from. And in the last 5 to 10 years, for reasons mostly we don't understand, it's slowed way down. And that might explain why wages haven't been rising for some time. It might explain a bunch of things. And when we come back in 10 years, let's hope we've gotten it back going to something like historical trends. Otherwise, I fear it's going to be even nastier and people are going to be even angrier.
Okay, well, we're all set up for next year. This is great. I also want to thank University of Chicago Booth School of Business for inviting me back and the panelists, because if they didn't approve, I would not be here. I've been working with Jane Rodriguez and Sam Gemielti, and they've been great, and it's always great to see you guys. Like I say, the room was just buzzing today. It's always fun to come here. Thank you so much for having me.